I take a trade on the futures market, specifically on the mini Nasdaq, going long with 2 contracts after identifying a key price level based on the volume activity visible on my heat map integrated directly into the candlesticks. This area clearly highlights a concentration of liquidity, which means a significant number of orders have previously been executed around this level. In many cases, these types of zones are defended by institutional participants because they represent prices where the market previously found an equilibrium between buyers and sellers. When price comes back to test this kind of level, it often creates a very interesting trading context because the market tends to react quickly when it reaches areas where liquidity is concentrated. At that moment, I'm looking for a clear reaction in the order flow, as well as an increase in momentum. When both of these elements appear together, it creates a favorable situation to enter the market on the long side, especially within a scalping strategy, where the goal is to capture a short but efficient price movement. In this particular case, once the market returns to this liquidity zone and the order flow confirms buying activity, I execute the trade and enter long with 2 contracts. My take profit is set at 69 ticks, positioned just below a high volume area visible on the volume profile integrated into the chart. High volume areas usually represent levels where the market spent a significant amount of time trading and where a large number of transactions occurred. Because of that, these levels often act as important reaction zones where the market can slow down, consolidate, or where traders may begin taking profits. For that reason, placing the take profit slightly before the level increases the probability that the order will be filled before the market potentially reacts or loses momentum. During the trade, the maximum unrealized drawdown remains limited to around $80, which is relatively small considering the size of the position. This confirms that the entry was executed on a clean technical level, where the risk was clearly defined and controlled from the beginning. As soon as the position starts moving in my favor, I quickly secure the trade at plus $60. This means that I move my stop in a way that locks in part of the profit while still allowing the market room to move. This step is extremely important in my risk management process because it helps reduce exposure to the market while protecting the trading capital. Once this adjustment is made, the trade becomes much easier to manage psychologically because the downside risk has already been reduced. At this stage, the objective is simply to let the market continue toward the initial target defined by the setup. The trading plan is strictly respected throughout the entire trade. I don't move my take profit and I don't interfere with the position unnecessarily. Maintaining discipline during the trade is essential because modifying targets based on emotions can quickly destroy the consistency of a trading strategy. While the trade is developing, I continue to monitor the order flow as well as the DOM, the depth of market, which allows me to observe how buyers and sellers are interacting with the current price levels. At this point, we can clearly see that buying pressure is progressively increasing. The buy column becomes almost twice as large as the sell column, which indicates a strong buying imbalance in the order flow. This type of imbalance usually means that aggressive buyers are entering the market, executing their orders at the ask price, and absorbing the available liquidity from sellers. As a result, the price tends to move higher as buyers continue lifting the offers. When this kind of imbalance appears near a key liquidity level, it often reinforces the probability that the bullish move will continue, at least over a short distance. All of these elements confirm that the trade remains perfectly aligned with the initial setup and that the market conditions continue to support the bullish scenario. The price continues progressing toward the target as the order flow remains supportive of the move. In the end, the trade is completed in less than 4 minutes while strictly respecting the original trading plan, the entry level, and the predefined target. The final result is a profit of $690 achieved while maintaining strict discipline in both risk management and position management. This type of execution perfectly illustrates the logic behind professional scalping.